Shane, how you doing?
I'm alive. You didn't ask how it's going. You asked how I'm doing this time. It's changing it up a little bit.
Yeah,
I
I gotta
like
keep
it.
you on your toes.
Yeah, no, I'm doing all right, man. All things considered. Market's finally behaving a little bit today, going down like it probably ought to, given all the crappy data out there. People, maybe all the buyers ran out of steam for a little while. I don't know. Some things are breaking out, some things are breaking down. The VIX is below 18, which I think is crazy. And No, who was out? One of the Fed heads was out earlier today saying that the Fed's going to need to continue hiking rates because inflation hasn't come down enough, and couldn't agree more. So we don't even have anything in here about the CPI, which came out earlier in the week. But core CPI, so excluding food and energy, is actually higher than headline CPI, which includes food and energy. So that's a little bit of a weird conundrum. And I think that's what the Fed is more focused on is the core services CPI, which is stubbornly high. And that's probably going to lead them to not be pausing their rate hikes. Certainly not going to be cutting rates anytime soon, I wouldn't think. So um, I don't know. I would have bet that that would have sent markets a lot lower this week, but that hasn't quite been the case. So um, yeah, I don't know what to say, man.
Yeah. Yeah, markets have been a little stubborn and we'll see right now, so we'll get to the charts, but kind of at a key level too, where we've failed before. So we'll see how that goes. But with that, we'll go ahead and flip it over. And for everyone tuning in, today is April 14th. So recording just a day later than normal, but getting it out nonetheless. So all right. So starting off, here's the reminder to everyone just what can happen in a bear market. We've seen rallies like this before after some pretty bad news too. So nothing unusual there, but
Yeah, just don't ever forget that when large banks go bust and get bought out for $2 a share, pennies on the dollar, and the market thinks that the problem is solved, it rises for potentially months, right? So this happened in March of 2008, and it wasn't until, mid-May. Um, so, almost 3 months, two plus months later, that the market finally broke and started to draw down again. So there was nothing good in the economy going on from March of '08 to May of '08. It was just a short-term celebration by people who thought that, oh, the problems are solved, and they sent out every type of government person to tell us that the banks were sound and our financial system could handle things, and that mortgage loans weren't going to be a problem. And then so everybody got all excited and bought stocks. And I mean, this level right here wasn't actually all that far from a new all-time high in the markets before things really got accelerated to the downside. So we're in this period right here where Credit Suisse, for example, was bailed out at I think it was 90 cents a share or something like that, by the Swiss bank UBS and the Swiss National Bank. And so we're kind of in this period right now where the market thinks all the problems are solved. But when there's that kind of stuff going on in the economy, it's only a matter of time before some other things start to show up that don't look so good. So I think that's kind of what's going on right now, and the market seems to be happy in the short term, but I think they'll end up being able to blame the government in the long term, just like they were for inflation, for example.
mhm.
So I think that short term fix is nothing but a short term fix, and probably there's going to be coming a time to pay the piper down the road. So that's kind of what I'm focused on. And these bear market rallies can just go on a lot further and for a lot longer than anybody thinks possible. And they're just, they're annoying. They bother me. So whatever. I just kind of have to laugh because
Yeah.
I'm a professional. I don't get FOMO. I'm not worried about it.
And that's a challenge. And so this is the chart of the SPY. And the big thing here, if I zoom out, it does kind of look like we're basing here, getting ready to break out and time to get bullish, right? But there's one thing to keep in mind. You have this, horizontal resistance right here at about 415 on the SPY. And this has failed, one, two, three, four, potentially 5 times here. So this is where I just want to sit back and let it show me. I mean, if it breaks over this, maybe that did change, as a trader, always keeping that as a possibility. But right now, it's just kind of going right back up into that resistance. We'll see where it
Yeah,
goes.
and
But
that line's been in play for a long time. I think like I might have mentioned last week. I'm trying to look it up right now, but yeah, that's been in play since June of 2021. That's been a level that, has been reacted to. It was both support and it's been resistance, one, two, three, four, at least 4 times since 2022. So I mean, yeah, there's definite that's a level to pay attention to. And we're not above it quite yet, and momentum seems to be declining a bit. So um, if all is right with the world, momentum will continue to drag down. We will have peaked, and this thing will drop below the trend line, and we'll see what happens from there. But that's
mhm.
kind of what I'm looking at happening. I will be surprised if we break higher from here, at least in the near term. I think the MACD needs some time to work itself out, but you never know. The right headline comes out, we could go much higher. So we'll have to keep paying attention.
Yep.
And if you look,
And
oh, sorry,
well,
you went ahead too a little too quickly, but you can see the 200-day moving average has begun to tick up again. Last time that happened, it failed and ended up going back down. But right now this is a little bit more sustained of an upswing in the actual 200-day moving average. And if you want to go to the next slide, this one just focuses on the 200-day moving average. So this line, this blue line here, is the 200-day moving average for the S&P 500. The gray line is kind of grayed out because I want it to sink into the background. But that is the price of the S&P 500. So same as the chart before, just less drawings on it. And as you can see, this blue line, the 200-day moving average, has been ticking up since March 28th, and it's now April 14th. And so that's 12 trading days that the 200-day moving average has consistently went higher. And what we said earlier in the Elevate chat that I don't know where I picked it up, but the 200-day moving average making a new high for the cycle 21 days in a row, which is basically one trading month, 21 trading days in a row. Could be the sign. It's some people's definition of a new bull market, definition of an uptrend. So that is the long-term trend. The 200-day moving average is the long-term trend. When it's pointing up, you're in an uptrend. When it's pointing down, you're in a downtrend. And obviously, we've been in a downtrend for quite a long time. Will the new uptrend hold? That is the question. So we got a little work to do there, and we'll keep our eye on it.
yep. And then turning to the NASDAQ, kind of the same thing. So if I just pretend that yellow line is not there and I'm looking at this chart, this looks pretty nice for a bullish entry or a long entry, but kind of same as the SPY or SPX. We're sitting there at that same line where we've come up to before, failed, and if it holds, it'd be a surprise, but something to take note of. And maybe that changes the thesis, but maybe it doesn't. Certainly you're going to come to question or areas in the chart or price range which might make you wonder, but until it breaks out of that range and shows its hands, you don't really know.
Yeah, it looks bullish. I mean, it's hard to argue with the fact that that looks bullish. I think it's mostly bullish right now because the 10-year yield has gone down, and people just look at the 10-year yield and say, "Well, the 10-year yield's down. I must want to buy tech stocks." But the 10-year yield is probably down because growth is slowing in the economy and because people want to buy bonds, not tech stocks. Um, and so, I think all the people who have been conditioned to just say, "Oh, 10-year yield down, buy NASDAQ." I think that's probably going to sort itself out in the long run. We'll see. But for now, I think that's why the Nasdaq is looking as good as it does, is because 10-year yields have come down a bit, and we'll get to some yield charts in a bit. Um, so yeah, I mean, you can't argue with these technicals. They certainly look super bullish. Just we're starting to make higher lows. Really, there's only one higher low here for the Nasdaq. There have been two higher lows for the S&P 500, but we've got a second higher high basically, and I didn't circle it, but this would be a higher high right here for the Nasdaq. So this one's a higher high, this one's a higher low, and then we got this higher high here. So it's if I didn't know anything about fundamental analysis or economic inputs, I would just be buying the heck out of this, and I think that's what a lot of people are doing, and I think they might get trapped in here before we take another leg down. So it's it's uh it's frustrating to be so bearish when the chart looks so good, I have to admit.
Yeah. And it's tough too, always about time frame. So if you're a long-term investor, the way you play this might be a little different than a trader. Trader might be catching some of this, but the fundamentals really weigh into what does the long-term picture look like, and it could be months or years before it really shows its hand. And in the interim, you just want to try and manage risk and act accordingly. So, and then Shane, this is the same thing you highlight on the SPY, I think. So we restarted that count of the 200-day going up and looking at 16 days. So, and remind me, what's your definition of total number of days, or the definition, I guess,
Yeah,
before it?
21 days was what the person I picked this up from said, and you pointed out that's basically the number of trading days in a month. So if it stays higher every single day for 21 consecutive days, I think you can call it a new uptrend. Doesn't mean it'll continue, can't like get crazy about stuff like that. I mean, it could go up for 21 straight days and then boom, the bottom drops out and it tilts lower again. So there's no such thing as a sure thing in the markets. That's why we always talk so much about risk management. But yeah, 21 days is the number that wherever I picked this up from, that's what they were saying.
Okay. And then Charles Schwab, this one, I think it's going to take a little time, but man, I still really like the fundamentals, I think are great. But then, coming down to this 45 level, this is up to, everybody's individual preference, I think. But the closer it gets to that line, the better that risk reward looks, in my opinion, for going up. So, you put a stop under that 45 and try and take that long. But I think it's kind of that baby, or the baby's getting thrown out with the bathwater with the banks. So
Yep. And we never really finished our analysis of the fundamentals of Charles Schwab. I think we started and we went through pretty detailed, and then we went quickly last week through a few like final details, but no real conclusions were made, and it's very difficult to get through 166 pages having like a full-time job. And not to mention, I have highlighted here, we will see new earnings on Monday from Schwab. So at this point, it just seems like a better idea to wait until the new quarter comes out and then actually dig into that a little bit more. I think we'll probably get some new disclosures. I think we'll find out that Schwab probably was a benefactor of a lot of the regional bank issues. I think a lot of the cash that came out of Silicon Valley Bank and Signature Bank and other regional banks, I think it found its way into Charles Schwab. Same as with JP Morgan Chase and the banks that reported this morning. They were all good news for the most part because they benefit at the expense of these small regional banks. Right? We're not so worried about JP Morgan having a run as we are a Silicon Valley Bank, for example, having a run on it. That said, JP Morgan's not immune. They're a bank first. Schwab is not a bank first. Schwab is a broker first, and they have like a little banking operation. And so even companies like JP Morgan Chase, dude, I was looking at their financial statement yesterday, their most recent one. I haven't looked at the new one that came out this morning, but they had $37 billion of unrealized losses in held to maturity securities. 37 billion. And that was up more than 11 times from the prior quarter, or sorry, from the prior year end. So during the year 2022, basically, they went from about 3 billion in unrealized losses in their HTM book to 37 billion. It was 11.5 time increase, which is ironically exactly the same as Silicon Valley. 11x increase in losses, unrealized losses. Now the difference is that the unrealized loss number was like gosh, I can't remember what it was. It was 15 divided by 212. So it was 7.5% of the assets at Silvergate, or not Silvergate, but Silicon Valley. Um, at JP Morgan, the 37 billion of unrealized losses is only 1% of the total assets that they have. So
Yeah, it's very different.
yeah, it still increased 11x, but it's still only 1% of the assets that they have. So it's probably not that big of a deal. And that's how you evaluate this stuff, right? Like that's why people are more comfortable having their deposits at JP Morgan than they are at a regional bank. I would say though that there's no reason to have more than the FDIC amount at any bank unless you're like a payroll provider and you have billions and billions of dollars going out, every single week or every single day. Like that's a whole different animal that I haven't really thought fully about. But anyway, that's enough of that. We'll get some more data from Schwab on Monday, and I will be attentively reading through their numbers.
Yep, that'll be something because the last earnings report that was before all the big bank news, and then now you've got this one. So I anticipate a lot of questions from the analysts, and it should be a good call. So we'll see what it brings. And then here's one, Shane, we've been kind of tracking the Fed balance sheet, and it was drawn down. You had that big jump up. Looks like now it's starting to trickle off again. Any thoughts there?
Yeah, that looks like more than a trickle. I don't know about you, man, but do you see any drops that steep anywhere else on this chart? Anywhere? I
So
mean, maybe there, but no. I mean, the angle of those drops is not the angle of this drop. I mean, so that's gnarly. I mean, they haven't done that much on a weekly basis, like ever.
hmm
And so that's the third week in a row since the banks started failing. And this is the bailout, right? And this is week one, week two, and week three since then, where the balance sheet's coming back down, despite all these banks still borrowing at the discount window and through the new facility. So I still don't understand how the balance sheet is rolling off by this much without actively selling it, which they said they weren't going to do. So yeah, I don't know. But I know that a reduction in balance sheet assets is going to lead to an increase in rates. So we're back to where we were like at the beginning of the year, right? So
Yep.
yep, that's it.
Yeah.
Balance sheet's basically flat for the year 2023.
Yeah. And then with that, this is the big, story we've been talking about is just the 10-year yield. So it looks like it's coming back up, but I think with this, sometimes you can get a pretty good move in there, but a lot of times it's gonna just consolidate for a while. So my own opinion, I think I wouldn't be surprised at all to see us kind of stay in this, 3.3 to 3.8% range. But maybe you have different thoughts on this one, but might be a little slower mover on this one.
Yeah, I don't have many thoughts. I think this is the most important price in the economy. I think it's coming down. I guess maybe you could draw, this line here. Um, I think it's in a downtrend, maybe even in a channel, right? And I wouldn't be surprised to see it back up here sometime soon. But I do think people are going to be buying the 10-year as growth slows in the economy. I think the market is still misreading, this drop in interest rates as a reason to buy the Nasdaq. But look, you know, this is the beginning of 2022 over here, right? So, call it a year ago in March of 2022, maybe April 2022, rates were less than 2%, or in April they were 2.5%. Now they're 3.5%. I mean, that's a double, right? From
hmm
1.8 to 3.6, call it. That's a double. And that means running a profitless tech company is a lot more expensive now than it used to be. It's a lot harder to borrow the money and finance the growth, especially if you can't make any money in your principal business. Um, so that to me, that's not a good reason. Just because rates are down from 4.3 to 3.5, yeah, they're still up from 1.5, call it, to 3.5. So they're up a lot more than they're down, depending on the time frame you're looking at. And I think people just get tunnel vision and take a very short-term approach to things. And I think that usually leads to them making a mistake and getting stuck on the wrong side of things. But it takes time. It can you look like a genius buying these tech stocks right up until the point where, everybody in the world says buy these profitless tech companies. We're in a new paradigm, and suddenly it's November of 2021 and the Nasdaq drops 35%
Yep,
subsequent to that. So, you'll look like a genius for a long time until the one day you finally don't anymore and you still don't sell. So,
that is true. And then, looking at the 2 year, it's kind of the same thing. So I think moving sideways, rates drop down for a little bit, but looks like they're going back up. And yeah, I think that one matters because that's just the short-term borrowing. So having those be higher, that's where the Fed's really impacting it. And again, just
yeah.
not good for growth.
Yeah, this 2-year rate more closely tracks the Fed funds rate. And I mean, it dropped from 5 to 4. So it's down by 1% in, a month, call it. And this is a direct result of the banking crisis happening. I mean, this is all at the same time. Um, but but again, like it actually looks like a steeper drop than the 10-year, right? It looks
Yeah,
like it. And that's what you would assume if you weren't looking at anything else. The next chart we're going to look at in a minute has them both together. But like year end 2021, dude, we weren't even at 1%. We were less than 1%. So we have more than 4x'd, right, in a year. So a drop of 1%. So we're right here, we're minus 1%. And here, we're basically plus 4% or maybe 3.5. Rates are up a lot more than they're down if you look at the right time frame. And so I would not get too short term on this. And if you go to the next chart, we'll actually see that. Oh, I guess it's not the next chart, but yeah, the yield curve, is still inverted. So the 10-year treasury is still lower than the 2-year treasury, and that means banks can't really make money doing their principal business. You can see every time the yield curve has inverted, it spikes, and then these gray areas are recessions. So inverted, spikes, recession.
yep.
Inverted, spikes, recession. It just kind of happens. So no guarantees that it'll happen exactly that way this time, but I think if you wanted to bet on probability analysis, probability is high that we do this again.
Yeah. And this is one where I think the accuracy on this is just about 100%. The only limiting factor is the sample size. So go back
Yep.
into the 80s here, but if we had it further back, that might be even more useful. But
It's not quite 100 because you got this one right here that didn't have the recession follow within 18 or to 24 months. It took a little bit longer and then the curve had to re-invert. But every single one of these gray boxes was preceded by an inversion, right? It's
mhm,
like I tell people all the time, every time I got drunk, something bad didn't happen. But every time something bad happened, I was drunk.
yep, I think pretty good analogy.
All right, so
And
this
then,
is the chart I was actually talking about. So the 2-year is the orange line. It did decline, pretty rapidly. The 10-year declined pretty rapidly as well. And we had a little uptick in the inversion down here. But it never uninverted, right? And remember, just because it uninverts doesn't mean that the all clear happens. That's what happens. The curve finally uninverts and then a recession occurs because people want to buy this 10-year bond. People want to buy this 2-year bond as we head into a recession because they're worried about growth slowing. So that's what happens is they go buy all these bonds.
yeah,
So that yield coming down is not necessarily a good reason to go buy tech stocks. Sometimes the yield going down is reflecting an imminent recession, and during an imminent recession, I can assure you, you don't want to own the Nasdaq.
hmm,
You want to own staples and healthcare, maybe utilities, right? But you certainly don't want to own profitless growth.
yep. And then
Oh,
here's,
sorry, can you flip back 1 second?
yep,
So check it out. The last time that the yield curve was positive, the 10s minus 2s was positive, was all the way back in July of 2022. briefly we inverted in April of 2022, and I was talking about that when I wrote my April 2022 commentary. I've pretty much mentioned it every single month since. And so it's no surprise to us that the banks are failing. This is how banks make money. With the curve inverted, they don't make money. Like they're paying more than they can earn, and they were buying all these bonds at crazy low rates anyway. So that's why there's so many unrealized losses on the balance sheets of these banks, is because they bought a bunch of bonds with their clients' money that was in checking accounts at ultra low rates, and now rates are so much higher that those bonds reflect a massive loss in value. So if you wonder about that, you can check out my recent commentary. I went through kind of some of those numbers, but this situation is going on across the entire industry. Global banking, everywhere you look, has the exact same balance sheet problem. It's just what type of magnitude.
Yep. And then here's one. This is just 10 years minus 3 month, and this one still inverting. So there, it's not taking a break at all. And again, not a positive thing to be seeing.
No, this is all-time low. I mean, this has
Mhm.
crashed to an all-time low. I don't know what people are thinking, but it's never gotten below 1. And now we're at minus 1.65. Like, this is crashing. So the 3 month yield is crazy high, which trips me out. I don't know why more people aren't buying these 3 month treasuries. We sure are. We're buying tons of them for clients constantly. Yeah, I bought some for 5% yesterday. It was 5.08% on a 3 year treasury. It's like, yep, I'll do that.
Yeah,
Much
that's
better than earning 0% in cash at Schwab, right? Schwab's still paying basically 0% on cash and brokerage accounts. All you got to do is buy a US Treasury that matures in 3 months, and you're going to get 5%. That's a big difference. I can't
hmm
believe more people aren't taking advantage of it. If you're not taking advantage of it, you should give us a call. We can help.
Yep. Yeah, it's definitely a nice thing to have right now. And again, in the light of inflation, so the real return on that isn't quite as good, but as an option right now, it's a great one. And then just looking at mortgages, at least here we're starting to level off a little bit. So 30-year is at 6.27, and then 15-year 5.54. So I would expect we'll probably hang out in this range for a while. Kind of it's based off the 10-year treasury, so much like that. I might see that where we just consolidate for a while.
Yep.
And then this one, Shane, I like this chart. I mean, it's just great for conveying the information. Obviously, it's not a positive chart, but just showing the number of bankruptcy filings and definitely up for 23, and the odds of a recession right now looks pretty
Yeah.
high. So,
Bankruptcy filings are up. Buy tech stocks. I mean, that's why rates are down, because people are buying bonds, and it should not follow that you want to buy tech stocks. I think that's gonna run its course, like I keep saying. So yeah, these are three really, really ugly charts that all kind of indicate that we are heading for a disaster. And you get that calm before the storm. People think, oh, they figured it out. The government bailed out the banks, everything's fine, and then wham, it's suddenly not fine anymore. So um, yeah, I read this in an email yesterday from Stansberry Research. Those guys are great. I feel like this might be the same publication where I picked up that 200-day moving average trending higher for 21 days, but I'm not 100% sure. So anyway, yeah, I mean, the chances of recession are at 99%, backed off from 100% like a week ago. One of my buddies pointed out that this tends to peak during the end of a recession. And arguably, we did have 2 quarters of negative growth in 2022, which, is usually the definition of a recession. But last year they said for some reason it didn't count. So
mhm.
maybe the history books will revise that and say, well, we've already been in a recession and maybe we're at the end of it. But I think we're probably just getting started. And this recession here lasted a pretty long time. So the COVID one was the shortest recession on record. So don't look for it to be that short again. Um, but yeah, I think we're headed into a recession. I think it's a virtual certainty. Um, and the only way not to have a recession is for the Fed to print a whole bunch of money, cut rates, and reaccelerate inflation from where it is back to 9%, and I don't think that's going to be a good call. So
Yeah,
I think the recession is a better choice, and just kind of rip the Band-Aid off. So um, that's where I think we're heading, and you don't want to be long stocks into that.
right. I agree. And then this one, so we had some retail sales numbers come out and not positive. It's not a great thing. Consumers not out there spending. Certainly factors in a company profitability as well. But any general thoughts on your end?
Well, yeah, I mean, a few. So not only was this month awful, uh, I mean, we were down 1%, which was way more, they say, than the market forecast of a point 0.4, a 40 basis point drop. So we lost more than double what the market was expecting, and the market was already expecting it to be bad. On top of that, we revised last month to a loss of 20 basis points. So now we got 2 consecutive months. The only reason that this one was good was because the holiday sales came through in
Hmm.
January, right? So um, so that's always an anomaly, but you can see the trend is not very good here. I mean, this is a very low trend, and there's been a lot of months that were negative during the time. So I mean, I don't know about you, but most people are not really out buying crazy amounts of stuff right now because things are expensive and we all see what's going on. So I think this is terrible news. This is why the market was down. I mean, I think it's a big reason that the market was down 1%, for the day as of right around the time we started this call. There'd been a little rally back, but market's dropping right now as I'm looking at it. This should send the market lower. Like this should terrify people. It really should. Like that's what should happen if you're paying attention.
Hmm.
And so, I look at every one of these numbers, negative, 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 negative. This one's negative. The minus is just over here. Um, on the other hand, sales rose 1.9%. Well, that's because at non-store, so online retailers, sales rose a little bit. So that's good. Good for them.
Yep.
Everybody else is getting smoked. And that's going to lead to a profit recession, right? Profits for S&P 500 companies are declining. That's going to lead to an actual recession in the economy, and stocks are going to get sold. That's how it's going to happen. And there's no telling how high the bear market rally can bounce before the bottom finally drops out. So pay attention.
Yep. And then this is the one I always like to look at this, and this is the University of Michigan inflation expectations. And expectations, I think, sometimes can be a self-fulfilling prophecy. So if inflation is expected to be high, then human behavior dictates that, buy now so that you don't have to pay so much later, which just creates more inflation. So I don't like this number, 4.6%. What's your interpretation?
No, that's a spike, man. I mean, that's higher than we've seen in the past 1, 2, 3, 4 months, right? And
Mhm.
nobody was expecting that either. I think that was totally out of the realm of expectations, especially because CPI came in lower than expected on Tuesday or Wednesday. Was it Wednesday? I
Yep.
can't remember which day. But yeah, this is not good, and I just think it's more of the same. I think it's a good reason to be bearish and keep your eye on what's going on. Like don't get caught up in FOMO. Don't look at the charts and say, "Oh, but the charts are bullish. We got to buy stocks or we're going to miss out. We're going to miss the rally." Look, if we're back in a bear or we're back in a bull market, you're going to have the next 3, 4 years probably to buy on dips and make ridiculous amounts of money on the upside. If the Fed's going to start cutting and printing money and sending rates lower and sales are going to be good and house prices are going to go back up and the wealth effect's going to kick back on and people are going to feel rich and spend a lot of money, and if all that's going to happen, there's no reason to be in a hurry to buy the bottom of this bear market. I mean, not the bottom, but you just don't have to rush back in. You got plenty of time. You get the rest of your life to buy the stock market on dips when it's in a bull market. So I think it's not. I think it's better to pay attention to the data and be frustrated by the charts and just stick to it and know that you're looking, what's happening, and that the things don't add up. So don't chase, and professionals don't get FOMO.
Yep. And then lastly, I just go into a little more lighthearted humor, but our Babylon Bee article hitting on inflation. Ramen was the only thing that the bunny or the Easter bunny could get out there this year. So
No eggs, no colored eggs this year, just ramen noodles.
yeah, the
Everybody loves their ramen.
eggs are expensive. Was it $9 a dozen now, I think. So
It's
it's not
crazy, man.
not cheap. So well,
Crazy.
Shane, thanks for joining again, and yeah, look forward to seeing everybody next week. Please like, subscribe, give us some comments or questions if you want us to cover some topics.
All right, thanks, Kyle. Have a good day, buddy. Good
Thanks
weekend
too.
too. It's
Yep.
Friday, baby.
Yeah, it is.
All
Have a good
right, see
one.
you, man.